We've seen the relentless flattening of the yield curve, whether it's the 2s, 10s, or the 5s, 30s. It's not quite the reliable recession indicator that perhaps it once used to be. A lot of people say that. Do you think it's a symptom of slowing growth, or will it be a trigger for a slowdown in growth?
Well, I think the real trigger is the short-term rate, and in the past, flat curve or even a negative yield curve, it's been the central bank that's been raising short-term rates much more than 5s and 10s, and that's what produces the flat curve. In a sense, the forward markets are anticipating that the Fed will at some point lower interest rates from the current level. So I think the real indicator to look at would be real Fed funds or nominal Fed funds, closer to 2%. At that level, it's close to a 2-year, it's close to a 10-year. And at that level, it's the 2% short rate, not the 10-year at 235 that threatens the economy going forward. So the Fed should stop soon, or else the economy will slow down.
How confident are you that the Fed gets it right and doesn't go above 2?
Well, I'm not. I've been arguing against the expertise of the Fed for a long time because they're based on models, the Taylor model, the Phillips curve, et cetera, et cetera. And I think to a certain extent, even though we may have a new regime going forward, that as long as they're model based on historical, types of cyclical indicators as opposed to structural changes like demographics and credit creation, then there may be problems. So I'm not confident in the academic approach to Fed funds in its entirety.